Welcome to the weekly market recap with SC Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. The World Bank says Sri Lanka is on track to regain its 2018 real GDP levels by 2026. According to its latest report, the country's growth prospects remain tied to how well it can sustain momentum beyond the current base effect. A 5% growth rate in 2024 has been recorded from a low starting point, and sustaining similar growth will be critical to long-term stability. The World Bank noted that with consistent growth, Sri Lanka could achieve its debt reduction goals with a smaller primary surplus. A surplus of just under 1.5% of GDP is seen as sufficient to meet debt targets provided growth continues. On poverty, the report highlighted that economic expansion could significantly improve household income and reduce hardship. At a baseline growth rate of just over 3% from 2026, poverty levels would only return to pre-crisis levels by 2034. But under a strong 5% growth path, the poverty rate could fall to pre-crisis levels by 2031, reversing nearly a decade of setbacks. The World Bank also cautioned that the country remains vulnerable to risks. These include high interest rates, exchange rate volatility, weaker growth, revenue shortfalls, and climate shocks. Another concern is a gross financing need target. Meeting it will be difficult unless the domestic market can absorb large volumes of long-term government securities to replace Treasury bills. The report concludes that sustained growth and careful fiscal management are essential if Sri Lanka is to achieve debt sustainability and ease the social impact of the crisis. Sri Lanka has made progress on its debt obligations, repaying $952 million to foreign creditors in the second quarter of 2025. This marks a significant increase from $406 million settled in the first quarter. According to the official data, repayments include $200 million in bilateral debt, up sharply from just $17 million in the previous quarter. The Public Debt Office reported that Sri Lanka concluded its debt restructuring with Japan in March. Soon after, bilateral agreements were also signed with the Export-Import Bank of India, covering lines of credit and buyer's credit, followed by an agreement with France in June. With these developments, Sri Lanka has now completed 92% of its overall debt restructuring. Authorities confirmed that regular debt servicing has resumed with these partner nations. During the same quarter, the country also repaid $330 million on its first international sovereign bond. This bond had been issued earlier to cover restructured interest arrears from previously defaulted bonds. As a result, the outstanding stock of sovereign bonds declined to just over $10.25 billion by the end of June compared to $10.58 billion in March. The latest repayment reflects Sri Lanka's continued efforts to restore debt sustainability and rebuild confidence among international creditors. Sri Lanka's private sector credit continued its strong momentum in July, with licensed commercial banks extending more than 200 billion rupees for the second month in a row. This marks 2025 as a record year for private sector lending. Central bank data shows that banks expanded total outstanding private sector credit by 201.5 billion rupees in July, following 221.6 billion rupees in June. Over the first 7 months of 2025, cumulative credit reached 901.6 billion rupees, surpassing the 790 billion rupees extended during all of 2024. This represents a year-on-year growth of 19.6%. Over the 12 months through July, licensed banks extended 1.49 trillion rupees in private credit. The expansion has been broad-based, covering agriculture, industry, services, and personal loans, although growth varies across sectors. The central bank left the key policy rate, the overnight policy rate, unchanged at 7.75% in July. It highlighted expectations for faster private sector credit growth in the second half of the year as previous rate cuts continue to support economic activity. The average weighted prime lending rate for top-tier borrowers currently stands at 8.16%. Quarterly financial reports for commercial banks indicate strong confidence in borrowers' repayment capacity. This is reflected in low provisions for potential non-performing loans. Private sector credit is widely seen as a key indicator of economic activity. The financial services component of the Services Sector Purchasing Managers Index has consistently led sector growth, benefiting from declining borrowing costs since mid-2023. However, some economists warn that the rapid pace of credit expansion could pose risk to external balances and price stability, given Sri Lanka's ongoing recovery from a foreign currency shortage. The central bank notes that previous years saw historically low or negative credit growth due to high interest rates and limited government borrowing. Repayments from public enterprises have also freed funds, allowing more lending to the private sector. The Planters Association of Ceylon has renewed its call for the government to lift the ban on oil palm cultivation, emphasizing its importance for growth in the plantation sector and higher worker incomes. The association noted that the 2021 ban has turned a previously promising crop into a missed economic opportunity. Oil palm, first introduced in 1968, gained momentum in the early 2000s as plantation companies sought alternatives to loss-making rubber. By 2016, the government had approved plantation expansions of up to 20,000 hectares. Plantation companies invested heavily in nurseries, milling facilities, and research. These efforts were focused on marginal and degraded rubber lands, with no significant and environmental concerns reported over 6 decades of cultivation. The sector has supported more than 5,000 direct jobs and 21,000 dependent livelihoods. Workers in oil palm earn nearly double the wages of tea and rubber laborers, and the industry contributes over 2.5 billion rupees annually to plantation households. Sri Lanka consumes around 264,000 metric tons of edible oils each year, yet local production now meets only a quarter of this demand. This shortfall costs the country an estimated $35 million in reserves annually, while substituting coconut oil reduces export earnings. Globally, palm oil is recognized as an efficient crop, producing 40% of vegetable oil on just 6% of land. In Sri Lanka, cultivation has been concentrated on old rubber lands rather than virgin forests. The association indicates that with proper regulation and adherence to international sustainability standards, the crop could be grown responsibly. Recommendations from the association include lifting the ban, adopting sustainability standards, integrating smallholder farmers, reforming import taxation, and investing in research and traceability systems. Observing India's experience, where palm oil cultivation expanded by 45% in 5 years, in Sri Lanka, with its favorable conditions, could potentially follow a similar path. The Planters Association emphasizes that the sector still holds stronger potential for revival and is urging the government to reconsider its stance in order to stimulate growth, protect jobs, and boost foreign exchange earnings. Let's take a look at this week's Treasury Bill auction results. With the recent Treasury Bill auction, the 91-day T-bill rate stands at 7.58%, the 182-day T-bill rate stands at 7.89%, and the 1-year T-bill rate stands at 8.02%, down by 1 basis point compared to the previous week. Thank you for watching. We'll be back next week.